Well, let's get into our day today. The financial markets are seeing greater portfolio diversification into environmental, social, and corporate governance, we all know ESG, linked investment. Our first panel for This America Zone today looks at what additional incentives are needed to boost capital allocation to ESG-linked investments in Asia and around the world. Moderating the panel will be Anne-Marie Godfrey, partner and head of fund practice at Aiken Group. She'll be joined on the panel by Carsten Stendevad, senior fellow at Bridgewater, the senior director and global head of ESG research sustainable finance at Fitch, Mervyn Tang, and Mark Delaney, deputy CEO and chief investment officer of AustralianSuper. Let's go now to Anne-Marie and her panel to find out more about ESG investing.
Good morning, everyone. We are delighted to participate in the Milken Institute's event this morning to discuss ESG and impact investing. I am joined this morning by a very esteemed panel. On our panel this morning, we have Carsten Stendevad of Bridgewater Associates. We have Mervyn Tang of Fitch Ratings, and we have Mark Delaney of AustralianSuper Fund. I'll start by introducing the panel. I'll say a few words about myself, and then we'll get into the discussion, which promises to be a very interesting and thought-provoking one. On the panel this morning, as I said, we have Carsten Stendevad. Carsten is a senior investment executive with a strong leadership track record with some of the most sophisticated global financial institutions across public, private, and non-profit sectors. Carsten is a recognized thought leader in the sustainable investment community. He's currently a senior executive at Bridgewater, where he's responsible for overseeing the firm's business in China, as well as its sustainable investing practice. He serves as a board advisor to GIC, which is Singapore's sovereign wealth fund. And he is a member of the board of directors at Nova Holding, the world's largest charitable endowment. He is the former CEO at ATP, which is Denmark's national pension plan, where he was responsible for both investments and operations. Then prior to ATP, Carsten was a managing director at Citi's investment banking division in New York. And prior to Citi, he worked for McKinsey & Company in New York and Copenhagen, and for the Central Bank of Denmark. He's trained as an economist at the University of Copenhagen, and he holds a master's in public policy from the Harvard Kennedy School of Government. We also are delighted to be joined by Mervyn Tang on the panel this morning. Mervyn is a senior director and global head of ESG research in Fitch Ratings Sustainable Finance Division, and he's based in Hong Kong. Mervyn oversees a global research team of 3, which primarily focus on the thematic and cross-sector ESG research. Mervyn rejoined Fitch Ratings in March 2019 from MSCI, where he was head of fixed income in the ESG research department. He worked with fixed income investors globally, supporting them on ESG in their investment process. Prior to joining MSCI, he was a director in Fitch's Sovereign Group within the Asia Pacific team, and he's also worked as an international economist for the Bank of England in London, a diplomat with the British Embassy in Washington, D.C., and an equities analyst at Citigroup. He earned an MSc in economics from Birkbeck College, University of London, and has a BA in economics and management from Oxford University. He's also a CFA charter holder. And last but not least, we're very happy to be joined by Mark Delaney, who is the Chief Investment Officer and Deputy Chief Executive Officer of AustralianSuper. Mark was appointed Chief Investment Officer and Deputy CEO in July 2006. He has formidable responsibility in investing around 180 billion of members' retirement savings. He has expanded AustralianSuper's in-house investment management capabilities, combining this with external advisors, and continues to deliver top quartile investment returns. Mark has over 20 years' experience in financial markets. He was previously CEO of STA, and prior to that, head of investments at STA. He has held senior positions with AXA and Federal Treasury. He has a Bachelor of Economics and is a chartered financial analyst. He's also a director of IFM Investment Advisory Board and Pacific Pension Institute, San Francisco. My name is Anne-Marie Godfrey. I head up the investment funds practice at Akin Gump, Hong Kong. I'm involved on a day-to-day basis in setting up hedge funds, private equity funds, and giving a lot of Hong Kong regulatory advice, working very closely with the Securities and Futures Commission here in Hong Kong. And I head up an investment funds team here. We also have offices in Singapore and Beijing, and I'm quite involved in those. So I think we'll continue with our panel discussion. And I'm going to turn to all of the participants on the panel this morning to ask them about the legislative and regulatory ESG initiatives in their respective jurisdictions, with focus on asset management and financial services generally. And I think with initiatives like the Second Shareholders' Rights Directive, the taxonomy regulations in Europe, Europe really seems to have led the way when it comes to ESG. But we live in a very interconnected world, and investors in Asia invest in Europe and vice versa. So my first question to the panelists is, to what extent do we see the rest of the world catching up with Europe on ESG? And what do you feel the impediments to that are? And I'll start with Carsten.
Well, thank you. Thanks for having me. I'm delighted to be here with this panel. You know, I feel like I've seen various phases of this ESG wave through my various professional vantage points across Scandinavia and US and in Asia. It feels like a movie that is played again and again at different speeds, and it starts at different time, but it kind of has the same plot. It starts with stakeholder pressure, then it's followed by regulatory pressure, and then the last phase really are the competitive pressures. And if I just think about that movie first in a European context, when I was appointed CEO of ATP, it was very much less than a decade ago. It was very much in the stakeholder pressure era. That was followed a couple of years after by regulatory focus, really around stewardship codes. And this was very much, I think, in Scandinavia, in Holland, in UK, you saw this. I helped write the Danish stewardship code in 2015, I believe. And that very quickly turned it from a regulatory issue to a competitive pressure, whereby today it's almost impossible to find investors, asset managers, or pension plans, asset owners in those markets that are not very, very focused on it. So that movie, I feel you're now seeing at different speeds in different regions. Certainly, I think in Australia, New Zealand, you see it. I think in Canada, you see it. Singapore, you see it. I just saw the RFP put out by the Chinese National Social Security Fund asking for focus on ESG mandates. So we really see it, I think, spreading. That kind of leaves the US, where I'm dialing in from, as kind of the latecomers to the movie. But even in the US, it's a tale, I think, of two, if not more, cities. You have some asset owners, certainly on the coastal areas, that are focused on it, endowments focused on it. On the regulatory side in the US, of course, it's been a bit an up and a bumpy road. Just recently, the Trump administration, the Labor Department put out, ERISA rules around ERISA pension plans that really reinforce the importance of ERISA fiduciaries only to focus on financial considerations. But if you just look at, in a way, already the competitive forces are so strong that most of the industry actually thought that was not the right role, that the importance of ESG should be reflected also in these rulings. So even in the US, it's kind of gone from regulatory pressures almost immediately over to the competitive pressures. So I think we're really seeing it all over the world.
Okay, Mark, I'll put that question to you as well, and perhaps you can focus your response on Australia and what's happening there.
Yeah, hello everybody. A very interesting panel. The ESG topic has been alive in Australia, I think, since maybe the early 2002 or something. I think I was involved in the first what was then called Corporate Governance Charter. So all the points Carsten made about it spreading around the world, I entirely agree with. That's the way it's going, and it's becoming absolute mainstream. The journey I've seen is one where it's merged from being governance first and around governance issues, particularly after the 2000 bust, with all those governance issues around companies like N1 and the like, audit committees, shareholder rights and whatever. It then developed into much more consideration of environmental, particularly climate change issues. I call that the second phase of ESG. And that's now become much more mainstream as those issues have evolved and it reflected the pricing of the stocks. And the third phase in Australia, and perhaps the most interesting one of all, is the merge into social. And what is a company's social license and social conditions? And can they maintain that contract with the community to maintain the longevity of their business? So it started with governance back in 2002, moved to environmental maybe 2008, 2009, and by 2018 was solidly on the social impact path. And I wonder what happens next, whether we have another letter to add to ESG as we find the next phase of where we develop.
Thank you, Mark. Mervyn, we've seen some interesting developments in Hong Kong in particular recently with the review that the SFC did of this sector, which has now led to some proposals for the asset management sector with a particular focus on the issue of climate change. Perhaps you can talk to us about what's happening in Hong Kong and Asia generally and how you see Hong Kong and Asia comparing with Europe in this space.
Yeah. Thanks, Anne-Marie, and I'm very glad to be here as well. I think in APAC, we're talking about a variety of jurisdictions all moving in different speeds and doing a lot of different things. I think where there's the difference compared to Europe is Europe has the broader Sustainable Finance Action Plan, which means there's kind of a lot of coordination on EU legislation and regulation on sustainable finance on all fronts, whereas in Hong Kong and the rest of Asia, it's more fragmented. I think one thing we see is that there's more of a focus on green finance as opposed to ESG. So as particularly in China, there's a lot of focus on the green bond guidelines. In Hong Kong and Singapore, support for the issuance of green bonds and development of green finance. That's not to say there's not developments on the ESG side. We're seeing stock exchange in particular coming through with voluntary corporate disclosure, ESG, sometimes moving to mandatory disclosure, and then governments occasionally now pushing through that process as well. So a lot happening there. I think we're also seeing quite a bit on the central bank side, and you mentioned climate as a focus. So we're seeing stress testing and environmental risks and disclosure being increasingly part of central banks pushing on financial regulators. So I think that's an important part. Now, I think where we might see progress as we move on in the future is where we have seen maybe Asia stand out is the incentive mechanisms put in place for sustainable finance. I think China in particular, if you see how the PBOC has accepted, say, green bonds as collateral, there's a lot of policy mechanisms being put in place to drive the incentive mechanisms for sustainable finance, which we have seen actually less elsewhere. That's not to say there's kind of, again, Carsten mentioned on the Nordic side, we've seen the Riksbanks start considering sustainability issues in the asset purchase program on the monetary policy front. No doubt there's going to be more and more of that going in the future, and I think APAC is going to be a significant part of that. Maybe the key differential actually in APAC is still a lack of a domestic market for ESG investments developing, and I think it will take a little bit more time for that to grow. A lot of the push on ESG has been more focused on attracting foreign capital. But pretty much when you're talking about a European asset owner, you basically require an ESG mandate to even compete for these funds now. And I think that is one of the big drivers of kind of the legislative and regulatory picture in Europe, in APAC.
Thanks, Mervyn. That's a very interesting overview of what's happening, particularly in China. I'm going to turn back to Carsten, given that you are working for a US asset manager. And I want to ask what initiatives Bridgewater are taking in the ESG space, and do you see this as a significant driver for your investors at Bridgewater, or where is the impetus coming from in terms of Bridgewater's focus on ESG?
Yeah, sustainability is a strategic priority for us as macro investors. It's a priority for our large institutional clients. It's becoming it is an integral part of our macro research, of our client advisory, and increasing also of our portfolio construction kind of solutions for clients. So it is a top priority for us and for our clients. And our starting point is really who we are as investors. We are macro investors. We spend all of our time trying to think about how the world works, try to map out linkages between economies and markets. And we view sustainability really through that lens. It's just through that macroeconomic investment research lens. And simply put, we don't really think that we can achieve our goal as macro investors, understanding the markets, if we don't also understand how environmental, social, and governance issues, how they drive markets. And we can already see that these issues are having ramifications for capital flows, for monetary policy, for fiscal policy, investor behavior. You can just see now during this COVID time how, if you think about fiscal spending, you can't really understand fiscal spending if you don't understand the drivers of how you make these choices around where the spending will be, taxes, infrastructure. That's true in the US, that's true in Europe, that's true all over the world. The same thing on the monetary policy, as we spoke about. These issues really are important. So therefore, it's just an integral part of how we think about macro research. It's also really driving a lot of our portfolio solutions for clients. I think our clients, clients for all institutional investors, are asking us many questions. One is they want to understand how this is integrated into our research and how it helps us create good risk-adjusted returns. And so a lot of our research is focused on that. But we're also seeing in our portfolio solutions, increasingly, we're seeing a very interesting trend, which is clients or it's big asset owners around the world asking about almost a third dimension to the risk and return, and impact. Really asking how is it possible to build portfolios that really try to maximize not just on risk and returns, but also take into account a broader sustainability impact aspect. And this is something we've been very, very excited about researching. We've been spending a lot of time on this question. It's a complicated one, conceptually, analytically, even implementation-wise. And really what we're trying to do is to see, is it possible to construct a total portfolio, like a strategic asset allocation, where every single security, you feel confident that they are aligned to a sustainability impact goal. In our case, we focus on the UN Sustainable Development Goals. But not only that, but that they're also put together so that as a portfolio, they deliver strong economic risk-adjusted returns across economic environments. In a way, I think we feel is the holy grail of investing, is if you can really achieve both goals in one portfolio. And that is a big part of our priority, and we're starting to steer capital towards that in the coming months. So very exciting topic for us.
Okay, that's very interesting. Thank you, Carsten. I'm going to move on to Mark. Mark, maybe you can tell us a little bit about how the superannuation funds in Australia are viewing the issue of ESG. Is there a demand from the ultimate beneficial owners of these plans? Is there a strong demand for ESG investment strategies? And also, I guess we know that in Australia, there are a lot of resources companies, and how do their employees view the issue of ESG?
Thank you. 3 questions and 3 good ones. The pension plans in Australia are long-term investors. We've got people's money for 40, 50, 60 years. Now, if your investment horizon is longer than 5 years, then ESG must be at a cornerstone of your investment approach. It must be, because that's really reflecting how society is evolving in the longer term, evolving environmentally, evolving with the governance arrangements, and evolving as a society. So you need to have that as a cornerstone of your approach. Now, there's 3 types of people who make capital allocation decisions. There's the pension plans themselves. There's the fund managers, who often act on behalf of the pension plans. And then there are the companies who make capital allocation decisions with the investors' money. Our task is to ensure that all 3 aspects integrate ESG into the decision-making process. So when we're buying stocks as AustralianSuper investor, we want to have ESG fully integrated into the stock selection decision, including its impact over the medium term. And importantly, some of those things are easy, but emerging social trends are harder to predict, but must be the cornerstone to some extent of how we think about those stocks. When we hire fund managers, we expect the fund managers to be doing the same process, fully integrating ESG into their stock selection process, working out whether they have environmental risk, working out whether they have a carbon risk, working out whether their labour practices are sustainable in the longer term, and whether the underlying business model is sustainable, which is not always the case. Finally, the rubber really hits the road with the companies, because they're the ones who allocate the capital to, if you like, a pro-carbon investment or a renewable investment. How are the companies doing those decisions? We don't want to be investing in companies who are investing in unsustainable business activities, because that won't work in the longer run. So getting all three aspects right is critical. The next thing you asked about is member demand. Well, we do ESG because we think it makes investment sense. It really is an investment activity rather than a member-led activity. We offer a sustainable investment option for members, but most people are happy to stick with our balance plan, which is sustainable in its approach in any event. So we think that there's lots of interest around ESG, and the trick with ESG is to be anticipating where these trends are developing over the next 10 years and positioning your portfolio accordingly. And we need the three legs: the fund itself, our fund managers, and the corporate sector to be able to implement that effectively.
Thank you, Mark. Mervyn, we spoke a little bit about the strategic review that's been undertaken in Hong Kong and the outcome of that, which has been a strong focus on ESG in the context of climate change. You mentioned the China and taking green bonds as collateral. So again, a focus on climate change. Do you see regulators in Asia taking a wider, do you envisage that they will take a wider view of ESG and also introduce criteria for around social and governance issues?
Yes, so I think there has certainly been more of a focus on climate and green at this current stage. But if we look across APAC, there are pockets of social issues that are particularly relevant in individual countries. I think, let's say somewhere like Japan, where the push for ESG has been strongly driven by the government, particularly the government pension GPIF. And I think one of the big social issues there has been gender empowerment, and you see the GPIF investing in kind of gender-linked indices. And I mean, that's a testament of kind of how it was linked to overall government policy because of Abenomics. One of the kind of key strategies was to improve female participation in the workforce, which Japan significantly needed. So I think that where there is a coherence between what government policy direction, where the government policy direction is going from a social perspective, you also see the sustainable finance system rally around those ideas. And so I think where there are particular social issues that are important for particular countries in APAC, I think that's where the sustainable finance system would rally around. I mean, actually, when people say that there's not been too much social focus, maybe one example that would kind of contradict that a little bit would be in China, where we've seen 90% of the issuance of, say, pandemic bonds. And the pandemic bonds are basically bonds where the use of proceeds are tied to some kind of coronavirus relief measures or package. Now, I think when you hear about COVID bonds, there's kind of mixed opinions amongst asset managers, asset owners in terms of whether they are fit neatly into that sustainability bond category. But it is a kind of it's a evidence that there is kind of where there is social focus at a policy level, there is development at the sustainable finance market level.
Thank you, Mervyn. So one of the things I see in my practice is asset managers putting language in their PPM that indicates that they are ESG focused, but when you really drill down, they're not as focused on the issue of ESG as you might think. So I want to ask the panelists about the issue of prescriptiveness of rules. How prescriptive do you think that ESG rules should be? And also, are you concerned about the issue of greenwashing? Maybe I'll go back to Mark first for that.
Yeah, I'm certainly concerned about greenwashing. I think back to presenting to a group of fund managers in the early 2000s about ESG, and we had to invite them to come along, and they were quite hostile about it. The reality is, I think, is a lot of fund managers are very conservative in how they view things and in terms of the social order. And so they bring their politics to work when they look at their portfolios. It might well be the case that you've got your personal political views or whatever, but the reality is that the world changes around you, and you need to have the best portfolio for the world you're going into, not the world you've left from. So the fund managers, knowing that they have to have an ESG credentials to get a mandate, will try and do the minimum possible. We as fund managers need to be very aware of that and make sure that they're doing a proper job. But in any event, if they're not progressive in their outlook, you wonder how they're going to be effective as underlying fund managers anyway.
Okay, Carsten, do you have a view on that?
You know, there's always a risk of some greenwashing, but ultimately I think that the market forces and stakeholder pressure will smoke that out. And so therefore, I don't think there's a need for very prescriptive ESG rules. In fact, the underlying principle in a lot of the stewardship codes that were written starting in UK and even the ones I helped write in Denmark and in Korea and all over the world had this basic notion of comply or explain, which really was, I think, the notion that you're forced to talk about it. You have to answer, tell us what you're doing, but we don't tell you what you have to do. And in some ways, if you have to start reporting on something and you have to put out your perspectives on something in the open, it has an incredible disciplining factor in that maybe the first year there's a bit of greenwashing, but I think very rapidly transparency and market forces are two incredibly strong principles. I also think the reason why I think it's important not to have too prescriptive ESG rules is that investors are different. And I think, in fact, I usually have like 3 principles for I think that an investor should think about as they think about their sustainable investment practices. One is authenticity. Like, is this approach authentic to who they are as investors? If you're a macro investor, that's different from being a long-only equity investor, which is different from being an activist, which is different from different approaches. And so do you have an approach that is thoughtful and that is authentic to who you are as an investor and your corporate culture, number one. Number 2, are you focused on things that are material for your investment style? So there's a ton of ESG topics all over the world. They're all important, but they may not be material for your investment style. And therefore, if it's too prescriptive, if the ESG rules are too prescriptive, I think it can lead to kind of check the box activities that is really not helpful for anyone. And I think the last one is it integrated? And I feel if you just ensure that you're authentic and you focus on material risk and it's really integrated, then I think the risk of it being a greenwashing goes away, because it's very easy to see if an investor lives up to those 3 principles.
Okay, thank you. Mervyn, can we get your views on that, please?
I echo Carsten's sentiment in that, yes, investors are different. And in some cases, when it comes to sustainability, there'll be different views on what sustainability is, and there might be different valuation or different weights put on the 3 things he mentioned in terms of investor objectives: risk, return, and impact. And so where you need to balance that is you need some kind of standardization so that an investor understands what a green label or ESG label or whatever label is used actually means, but you can't necessarily go far as prescriptive and say exactly what is sustainable or not. Because let's take an example, even in the EU, when we look at the debate around nuclear energy in the EU taxonomy, I think some people, some people see it as a viable low carbon alternative, which is needed, particularly in fossil fuel reliant economies, as part of the low carbon transition. Some see that the environmental waste implications and kind of the broader safety issues is going to be too much. I mean, you can have a reasoned argument on whether that is a sustainable alternative or not. That extends to things like large hydropower and a whole range of other social issues. And so I think you you need some kind of regulation and standardization to kind of clarify meaning, but not necessarily so prescriptive that it defines entirely what sustainability is.
I think it's also important that in a market, you need people on each side of a trade, and it's natural that people will value things differently. In fact, I think the more one gets into the topic of sustainability, the more one realizes this is not a black and white issue. These are all shades of gray or shades of green. And in fact, it's at the end of the day, therefore, the main thing that one has, I think one can use is, do you have a analytical framework that's clear for how you think about the world? Do you have a systematic approach to have your entire investment process follow that, in a way, analytical framework, so that, but you're systematic about how you're assessing it? Do you have a kind of a triangulated view on, don't trust your own views too much, but make sure you have a triangulated view of what other people think and various data sources believe? And then do you have a way of actually testing at the end of the day that whatever your outcomes are in the investment portfolio, that they link back to your original goal? I think if you do that, if every investor does that, they will do different things, but I think it will lead to good investment practices, and it will be better for sustainability also, but it will not all be the same.
Thank you, Carsten. One final question for each of the panelists. We've spoken a lot about ESG as a carrot for investors, as something you need to have in order to attract capital. But can we talk a little bit about the risks of not having a good, sound ESG policy in place? Mervyn, maybe I'll start with you on that.
Yeah, so for us as a credit rating agencies, we've had investors and asset owners banging on our doors saying, we need to understand how ESG is incorporated into credit ratings, because there's a really important risk component here. I mean, Carsten talked about triangulated thinking and the kind of big macro linkages of ESG. I mean, that's absolutely right, because if we take an issue like climate change, it's something that's systematically affecting all of our credit assessments. And so the fact that governments are tightening climate regulation and introducing carbon pricing and offset mechanisms means that the world is changing, and we need a coordinated way of thinking about how that all links together. And I think that's true for investors as well. If you don't have this coordinated way of thinking about these risks, it's easy to misstep, and it's easy to misunderstand really kind of where your portfolio risks lies. I think especially when Mark started talking about the time horizon component, another thing that we kind of focus a lot on the credit rating side, because typical credit rating horizons from a forecast perspective is kind of 3 to 5 years, but a lot of these climate risks can be 10 years and beyond. And you need a way of marrying that short term and long term. And I think if you're not thinking about kind of ESG in a systematic context, you can lose sight of how that time horizon assessment should be managed.
Thank you, Mervyn. Carsten, can we get your views on that issue, the risks associated with not having a good ESG policy in place, and what can go wrong?
Well, I think a few things. I think first, from an investment perspective, I think we've all argued that these matters already are important to understand markets and individual securities and economies. And so if we believe it's important to understand, then it's problematic if, as investor, you don't really focus on it. So I think that's point number one. I would also say, again, from a stakeholder and even a commercial perspective, I think it's very difficult in this day and age to not be focused on this. On the stakeholder side, I think there is an expectation. I think, Mark, you mentioned almost like a social contract that you engage thoroughly in these matters. So I think that's very important. I would also add that I think it's very important to not to ensure that we are as stringent analytically on this topic as we would be on any other investment topic. It is not helpful, I think, to anyone. You mentioned greenwashing before, but even not applying stringent investment thinking, analytical thinking to this field is also problematic. So I think it's as problematic to have folks having strong ESG policies and then not be stringent about it and not have clear-eyed investment thinking. I think that is also bad. It's not just not having a policy on it. And in fact, I think what I predict, or I think that what we will see is a bit of clearing out also of a lot of the almost like soundbite level statements on the importance of ESG that's not backed up by anything, I think we will see over time that a lot of those, both those arguments, but potentially also some of the investment strategies that have been backed up by strong analytics will suffer. So that's, in a way, it's natural. Every time you have these big movements, there's a sorting out of everyone jumps on the bandwagon. Most hopefully are being very serious about it, some less so, and that leads to a natural almost evolution where hopefully the strongest and most analytically strong approaches where they win out.
Okay, Mark, can I put that question to you?
Yeah, a couple of points. The first one is my overarching belief is that ESG is moving from being a sideline activity where there's niche securities around it and niche activities to the main game and becoming fully integrated into the investment process. On that point, I'll be fully integration. As investing, it's not overly difficult. All you have to do is to evaluate what you think the future cash flows are of the investment you're buying. Now, ESG factors will be a big factor in some companies' future cash flows, for certain. Now, the fact that they're harder to quantify doesn't make them less important. So traditionally, investment analysis has weighed itself to think more to things which can be quantified and less to things which are unquantifiable or qualitative factors. ESG is a classic case where qualitative factors will have a big influence upon quantitative outcomes in the future. So getting people to be better skilled at analysing and handling non-quantitative factors in their investment analysis will improve the process dramatically, I think.
Okay, thank you, Mark. I think we do have time for one more question. Mervyn, you mentioned ESG considerations being incorporated into credit ratings. Can you elaborate on that a little for us?
Yeah, absolutely. So I think for us as a credit rating agency, where we kind of have to look at ESG risk is how that translates into credit risk, which means identifying the transmission mechanisms. And when we started doing that, we found there's actually a huge amount of ways that ESG can affect credit ratings. The most direct way is the way that the sustainable finance system is developing. It means that financing conditions are going to be affected by ESG. So when, let's say, banks start pulling away from coal because of their new kind of environmental mandates, that leads to potential financing risks for coal entities and those in the supply chain. But it's not just that. I mentioned climate regulation, carbon pricing before. The fact that some of these environmental and social and governance externalities are being more recognized by the general public means that it's often translated into policy. And so when those policies start materializing, it does impact the cash flows, as Mark says. But it's not always a policy issue. We've seen, let's say, when an NGO pushes a European European company, they might no longer be able to, say, buy palm oil from an entity which is unsustainable just because of their customer preferences and the reputational shock. So there's all these chain effects happening when it comes to ESG and how it impacts the financial profile. And it just becomes important for us as well as everyone else to understand them.
Okay, thank you. Well, I don't know if anybody else has anything else to add or anything else that they feel is important to get across to our audience this morning.
Well, I would just maybe to Mervyn's point, I think it's very exciting to see what has happened in the broader, both on the analysis side, whether credit rating agencies or many types of institutions that really are trying to analyze these topics. There's a proliferation also of data providers. You often hear the argument that, well, the data is not good, or as you mentioned, Mark, that it's too qualitative. But that's not a challenge just confined to the world of sustainable investing. I mean, often in investing, you're faced with imperfect data. You have to sort through data. You have to make sense of it. You have to assess the credibility of it. You have to come up with triangulated views. And in a way, I feel it's excellent to see this huge development in the data industry and in the analytical industry, because it gives us investors more and more tools, and then we can use whatever systematic investment approach we have elsewhere we should deploy or apply that same systematic approach to this field. And I think it's very, very exciting. And I think for years to come, we will see really sophisticated portfolio solutions coming up in this area. And I'm just excited to be part of it.
Great. Thank you, Carsten. Mervyn.
So I was going to say, I agree with Carsten. So I think we're in this exciting nexus where we're seeing the development of technology and data analysis in the form of big data along with ESG. And so it's not just about, let's say, what corporates disclose about how sustainable they are. It's about finding, let's say, the geolocational data of different assets and then trying it to say how that might be affected by physical climate risk and then aggregating that to some kind of assessment of financials in some way. There's just so much information out there. You have people who are employed to look and monitor supply chains and kind of give you survey results so that you can understand that kind of broader social risk on the supply chain channel. There is just a huge amount for us all to deal with over the next few years.
Mark, would you like to add anything to that?
It's hard to add much to those two comments. I think that data will come to ESG. Measurement comes to everything in life sooner or later, and it's going to come to ESG, and ESG will be better for it.
Thank you. Thank you. Well, with that, I would like to say thank you to our panelists for their insightful views and for keeping us bang on time this morning. And thank you to the audience for listening. And thank you.